Welcome to The Deep Dive, the show that extracts the most important nuggets of knowledge from a mountain of sources, just for you.
Glad to be here.
Today, we're digging deep into an industry that's not just facing change, but, well, a true revolution. Regional banks. This isn't about minor adjustments. We're talking about a defining inflection point, really, in 2025.
That's a good way to put it.
It's a moment where powerful, disruptive forces are converging, demanding immediate and pretty decisive action.
That's exactly right. What we're seeing is quite unique. We've been calling it a three-pronged squeeze on these regional banks.
Okay, three prongs. What are they?
First, there's just intense margin pressure. And this isn't just a slight dip, it's a structural assault. It's driven by shifting interest rates, significantly higher funding costs, and honestly, fierce competition for every single deposit.
So their core engine, net interest margin, is just constantly under pressure.
Constantly squeezed, yeah. Think of it like that.
And that squeeze really hits them where it hurts, doesn't it? Their primary way of making money.
Absolutely. Then the second prong is this immense technical debt.
The old systems.
Exactly. Many of these institutions are grappling with decades of aging legacy systems. We're talking the sheer cost, the complexity, and the, frankly, significant risk involved in trying to shed that burden.
It sounds like trying to upgrade a plane while it's flying.
Or maybe like trying to navigate a Formula One race with an engine from the 1950s. It's that kind of mismatch.
Right. Okay, and the third prong?
And finally, the third prong is this multi-front competitive war. They're no longer just competing with the bank down the street.
Okay.
They're up against the massive national banks, the hyper-agile fintechs, non-bank financial institutions that, aren't weighed down by the same regulations.
And even the big tech companies, looming large.
And even the looming presence of tech giants.
Yep.
Yes.
So it really is a perfect storm. For you, our listener, our mission today is to cut through that complexity. This deep dive is your shortcut to understanding what's truly going on in this critical sector, what's most important for their survival, and crucially, what strategies they must execute to succeed.
And it's not about tackling one problem at a time in isolation. It's about understanding a holistic, integrated approach. These challenges are all interconnected.
It's a fascinating and pretty precarious tightrope walk for them right now.
Okay, let's start with the big picture, because that external environment really sets the stage for everything else.
Absolutely.
We're talking about what feels like a macro-regulatory gauntlet. The economic outlook for 2025? Well, it's one of cautious navigation through potentially turbulent waters.
Cautious is the right word.
After a surprisingly robust 2024, the forecast for U.S. GDP growth is projected to decelerate quite a bit, down to approximately 1.5%.
Yeah, that's a significant slowdown.
And it has direct implications for the banks.
It does, and the implications for bank profitability are, well, far from simple, despite what you might initially expect.
While we are anticipating Federal Reserve rate cuts, potentially bringing the federal funds rate down to a range of, say, 3.50% to 3.75%.
Which sounds like it should help them.
You'd think. But the real challenge for banks is the persistent compression of their net interest margins, their NIM. The fierce competition for deposits is coming from every angle. The large national banks, online-only institutions, agile fintechs.
Oh, offering better rates.
They're all offering higher yields, which keeps funding costs incredibly elevated for regional banks. This means even if the Fed cuts rates, their overall cost of acquiring deposits remains stubbornly high.
So even if the Fed makes borrowing cheaper for the economy generally, regional banks are still facing these elevated costs just to bring in deposits. That must really constrain them.
Precisely. To give you a sense of the pressure, aggregate deposit costs are projected to be around 2.03% in 2025.
Wow. Compared to what normally?
Well, that's substantially higher than the 5-year average, which was about 0.9%.
It's a huge difference.
It's not just a minor fluctuation, it's sustained pressure. It forces banks to aggressively seek alternative avenues for top-line growth because their traditional engine is, well, sputtering.
Okay.
And adding to this, there's the lingering shadow of past rate hikes. That's still very real.
The unrealized losses on their books.
Exactly. In Q4 of 2024, regional banks were still grappling with a massive overhang of unrealized losses on their securities portfolios, totaling a substantial $482.4 billion.
Nearly $500 billion.
Almost $500 billion. What this really means is that nearly $500 billion of potential capital is locked up in assets that have lost value.
And that directly hurts their capital position.
It acts as a direct drag on their tangible capital, limiting their balance sheet flexibility and, crucially, their capacity to make those strategic investments in necessary technology and talent that we'll definitely discuss later.
It's a huge number, almost $500 billion, just sitting there as a loss, basically restricting their ability to move.
It really ties their hands in many ways.
That's a sobering figure.
Huh.
And it's compounded by weakening consumer and corporate health, right? The very foundation of their loan book seems shaky.
It absolutely is. The American consumer, who has been a primary engine of growth, is definitely showing signs of strain.
How so?
Total consumer debt has surged to an all-time high of $17.7 trillion, while those excess savings people built up during the pandemic mostly depleted by early 2024.
Gone.
Pretty much. You're seeing the financial strain manifest in deteriorating credit quality. Delinquency rates for credit cards and auto loans are now rising above pre-pandemic levels.
Not good.
And on the corporate side, small businesses, the lifeblood of regional economies, they're facing tighter financing conditions and the lingering effects of inflation.
So trouble potentially brewing in commercial loans, too.
All of this signals potential stress brewing in commercial loan portfolios down the line. It increases the risk of loan defaults.
Okay, so that's the economic backdrop.
Yeah.
Now, what about the regulatory side? You mentioned this year of regulatory shift.
Yes. So if we connect this economic picture to the bigger regulatory landscape, 2025 is really shaping up to be the year of regulatory shift.
Meaning?
We're talking about a landscape defined by significant uncertainty, complexity, and fragmentation. A primary driver of this is the potential for a new presidential administration.
Ah, politics.
Right. For example, a new administration could very well pursue a deregulatory agenda. They might potentially revoke executive orders on areas like AI governance and finance, or climate risk disclosure requirements for banks.
Or even ease up on bank mergers.
Or even easing restrictions on bank mergers, yeah.
That sounds like it could offer a potential easing for banks, maybe a sigh of relief.
You'd think so, but maybe not so fast. While that might be the initial sentiment, history shows that fundamental changes to financial supervision are implemented slowly, very slowly.
So don't hold your breath.
Banks absolutely cannot afford to relax their focus on risk management and compliance. Instead, they must prepare for a period of policy ambiguity, planning for multiple potential regulatory scenarios, because the reality on the ground rarely shifts as quickly as political rhetoric.
Got it. Plan for anything.
And regardless of the political direction, the supervisory focus on issue remediation will remain intense. Regulators are demanding that banks demonstrate sustainable, verifiable improvements in their GRC frameworks, governance, risk management, and compliance.
They want proof things are fixed.
Exactly. Institutions that fail to address outstanding supervisory findings promptly and effectively risk being placed in what's called the regulatory penalty box.
And that's bad.
Oh, yes. This status can severely hamper their strategic flexibility, including their ability to gain approval for mergers and acquisitions, which, as we'll discuss, are so vital for growth right now.
So they're under a microscope, and if they're not cleaning up their act, they could be sidelined from crucial strategic moves, like growing through acquisition.
Precisely. And it's not just the banks under scrutiny, interestingly. The regulators themselves are facing internal adjustments. Reports from the FDIC's Office of Inspector General and the GAO have identified weaknesses in their processes, particularly for resolving large regional banks and escalating supervisory concerns.
So the watchdogs are being watched.
Essentially, yes. This suggests internal adjustment for the agencies that will inevitably impact their interactions with the industry, potentially making oversight even more rigorous in some areas.
Okay, so maybe more scrutiny, not less. You mentioned fragmentation.
Yes, this raises an important challenge.
Yeah.
How do you navigate a regulatory environment that's becoming increasingly fragmented? We're seeing diverging requirements across different federal agencies and, maybe more significantly, between the federal and state levels.
An example.
Think about new areas like AI governance or data privacy laws. You've got California's CCPA, but other states are doing their own thing too. Or even cybercrime reporting requirements.
Different rules everywhere.
This patchwork of rules increases compliance, complexity, and operational costs, and it creates a disproportionate burden on regional banks. They might operate across several states, but often lack the vast compliance departments that their national competitors possess.
So it's not a single rule book, but dozens of little rule books they have to piece together, each with its own nuances. That must be incredibly challenging for institutions with limited resources compared to the behemoths.
Exactly. It's a significant overhead cost. And a perfect illustration of this state of flux is the ongoing uncertainty surrounding the Community Reinvestment Act, or CRA.
Right, the CRA rules keep changing.
The 2023 CRA final rule, which was a landmark effort to modernize this decades-old regulation, is currently stayed by a court injunction. It's on hold.
So what happens now?
Well, now, in response to legal challenges and industry concerns, the federal agencies have jointly proposed to rescind that 2023 rule and just go back to the earlier regulations from early 2024.
Backwards.
Essentially, this regulatory limbo creates significant strategic uncertainty for banks as they try to plan their community lending, investment, and service activities to meet their CRA obligations.
It sounds like they're trying to hit a target while the target keeps changing shape and moving to different locations. That makes planning almost impossible.
Incredibly difficult for long-term planning, yes.
Now, let's drill down into specific risk areas that regulators are really zeroing in on. You mentioned commercial real estate. CRE is top of that list.
Yes, absolutely.
Why is CRE such a significant weak point for many regional banks right now?
CRE, particularly the office sector, has indeed emerged as the most significant systemic weak point for many regional banks. There was a stark data analysis from Florida Atlantic University.
What did it find?
It revealed that 67 of the nation's largest banks have CRE exposure exceeding 300% of their total equity.
300%, that sounds high.
That's a critical threshold that regulators view as an indicator of excessive risk concentration.
And for some, it's even higher.
To give you a sense of just how concentrated this exposure is, for some institutions, it's even more alarming. Flagstar Bank, for example, reported CRE exposure of 553% of total equity. Zion Bank Corporation stood at 440%.
Wow.
What this really means is that a significant portion of the banking system is placing an incredibly concentrated bet on a sector facing historic headwinds. It's less a diversified portfolio and more a high-stakes poker game for many regional players.
Those numbers are staggering. So their balance sheets are heavily tilted towards this one asset class. What's the specific danger there?
This high concentration becomes particularly dangerous when it's coupled with a heavy reliance on uninsured deposits.
Like we saw in 2023.
Exactly. It creates a vulnerability to rapid deposit flight, reminiscent of the bank failures we saw in the spring of 2023.
So the question is?
This raises an important question. How will these banks manage when a substantial volume of CRE loans are scheduled to mature and reprice in 2025? Many will face severe refinancing challenges.
Meaning losses.
Likely forcing them to recognize significant losses and write down the value of these assets as property valuations continue to decline, especially in office space. It's a looming reckoning demanding proactive management.
Okay, so CRE is a big one. What else are regulators focused on? Liquidity.
Yes. Beyond CRE, the events of 2023 served as a powerful reminder of the paramount importance of robust liquidity and funding risk management.
Even though the system is generally sound now.
While the banking system has been assessed as generally sound, the digital age has fundamentally altered the nature of liquidity risk. The speed at which deposits can now flee an institution, it demands more dynamic and sophisticated management strategies.
Faster withdrawals need faster defenses.
Right. This includes a greater emphasis on diversifying funding sources and utilizing tools like reciprocal deposit networks. IntraFi is a good example.
How do those work?
They allow banks to offer FDIC insurance on large deposits by essentially spreading them across a network of participating institutions. This mitigates the risk of uninsured deposit flight by providing broader coverage.
Clever. So it's not just about having enough cash on hand, but ensuring the cash is stable and not susceptible to those quick digital withdrawals, which we saw happen at unprecedented speed last year.
Exactly. Speed is the new factor. And the scrutiny isn't just on financial risks anymore.
What else?
Non-financial risks have ascended to the top of the regulatory priority list. Operational risk, in particular, is a primary area of supervisory focus.
How serious is that focus?
The KPMG Regulatory Barometer quantifies this pressure. It assigns operational resilience a score of 8.2 out of 10. That's one of the highest pressure areas for financial firms.
And what's driving that? New rules.
This intensity is driven by new, stringent regulations like the Digital Operational Resilience Act, or DORA, in the EU, and similar requirements emerging in the UK. DORA, for instance, sets incredibly high standards for how banks manage technology and cybersecurity,
Such as?
requiring them to report all major cyber incidents and prove their resilience through rigorous testing. It forces banks to reevaluate their entire operational ecosystem, including their third-party vendors.
It sounds like a tightening of the screws across the board.
Yeah.
So what does this all mean for the banks trying to navigate all of these pressures at once? It sounds exhausting.
It creates a vicious cycle for many regional banks.
Explain that cycle.
The intense regulatory focus on remediating existing issues, which often stem from weaknesses in governance, controls, or, importantly, outdated technology, forces banks to divert a significant portion of their budgets and leadership attention to what we call run the bank activities, just keeping the lights on and meeting compliance demands.
Okay.
This diversion of finite resources comes directly at the expense of crucial change the bank investments, things like legacy system modernization and AI deployment.
The things they need to do to compete.
Precisely. The failure to make these strategic investments perpetuates the very technological and operational weaknesses that likely contributed to the initial regulatory finding in the first place.
So it's a feedback loop. Fix the old problems, no money left to build the future, which causes more problems.
Exactly. It's a feedback loop that can trap a bank in a state of perpetual remediation, preventing it from making the forward-looking investments necessary to build a more resilient and competitive foundation.
And that vicious cycle you just described, where remediation eats into modernization budgets, it really highlights why digital transformation has become so urgent for these banks. It's no longer just a nice to have, is it? It feels like an existential imperative.
You've hit on it. It truly is. The problem of technical debt runs incredibly deep for many regional banks.
Now deep.
They're often operating on technological foundations that are decades old. We're talking core banking systems built on antiquated programming languages like COBOL.
Still using COBOL.
Yes.
Wow.
These systems are characterized by brittle, custom-coded integrations and a profound lack of data portability. Data gets stuck.
So it's not just inefficient, it's actively harmful.
It's a strategic liability. It actively hinders agile product development, stifles their ability to respond to market changes quickly, and creates significant operational and security risks.
And it costs a lot just to maintain, right?
Absolutely. To top it all off, the cost of simply maintaining this outdated infrastructure is substantial and continues to rise, exacerbated by a rapidly shrinking talent pool of programmers who actually know how to support these old systems.
So it's not just that they're old, but they actively prevent them from innovating and create new risks. Traditionally, when you talked about fixing these systems, it was this massive rip and replace project. Years, fortunes spent. Has that approach changed?
Yes, thankfully. The old rip and replace model was a high-risk, multi-year, frankly bet-the-bank proposition.
Understandably scary for boards.
Exactly. It led to paralysis in many boardrooms. Today, more pragmatic and less disruptive modernization pathways have emerged.
Like what?
Rather than a monolithic overhaul, the modern approach is incremental and modular. This often involves replacing legacy components one by one with modern, cloud-native solutions that communicate through API's application programming interfaces.
So piece by piece.
Piece by piece. This allows a bank to prioritize the modernization of high-impact areas first, like digital account opening or loan origination. They can generate tangible business value and get what we call quick wins.
And those wins can help fund the next step.
Exactly. They help fund the next phase of the transformation. A central challenge, though, is carefully extracting and preserving the invaluable intellectual property, the complex business rules, the deep institutional knowledge that is often hard-coded into these legacy systems. That's tricky.
Right, you don't want to throw the baby out with the bathwater. And underpinning this entire modernization effort is the foundational role of cloud computing. What makes the cloud so transformative for banks?
Migrating from on-premise, often mainframe-based infrastructure to the cloud is really the bedrock of a modern banking architecture. The benefits are truly transformative.
Such as?
Cloud adoption enables a crucial shift from heavy upfront capital expenditures, CapEx, to a more flexible, consumption-based operational expenditure, or OpEx, model.
Pay as you go.
Think of it like moving from owning a huge fleet of delivery trucks, a big upfront cost, to subscribing to a delivery service where you pay only for what you use.
Okay.
This offers immense flexibility and allows for dynamic scalability to meet fluctuating customer demand. This dramatically increases the speed and agility of the organization,
Faster product launches.
allowing for the rapid deployment of new products and services and enabling modern software development practices like CI/CD, continuous integration, continuous deployment, and DevOps.
So it's faster, more flexible, and cheaper in the long run. That sounds like a no-brainer. Why isn't everyone already there?
Well, on the surface, yes. And furthermore, cloud platforms provide a level of security and resilience that few individual banks could afford to build on their own.
Better security, too.
They leverage the massive ongoing security investments of the hyperscale cloud providers, think Amazon, Microsoft, Google for superior threat detection, data encryption, disaster recovery capabilities. And most importantly, perhaps, the cloud serves as the essential enabling platform for the advanced analytics and artificial intelligence capabilities that are critical for personalization, risk management, and future growth.
Hmm.
You need the cloud for AI.
Right. But you said on the surface, what's the catch?
However, and this is where it gets really interesting, the migration to the cloud introduces a critical cultural challenge that many banks underestimate. It's called the shared responsibility model.
Shared responsibility. Between who?
Between the bank and the cloud provider. In a traditional on-premise data center, the bank's IT department is 100% responsible for the entire technology stack, top to bottom.
Right.
In the cloud, this responsibility is divided. The cloud provider is responsible for the security of the cloud, the underlying hardware, the network, the physical facilities.
Okay.
But the bank is solely responsible for security in the cloud.
What does that include?
This includes the correct configuration of access controls, the management of data encryption keys, the security of the applications they deploy on the cloud, and the governance of who can access what data within their cloud environment.
Give me an analogy.
Think of it like renting a secure apartment building. The landlord, the cloud provider, ensures the building itself is structurally sound, has secure entrances, maybe security guards.
Okay.
But you, the bank, the tenant, are responsible for locking your own apartment door, setting up your alarm system inside, maybe deciding who gets a key, and making sure your guests don't leave the windows open.
Got it. So it requires a different mindset from the bank.
It represents a fundamental shift in accountability. And if this isn't addressed through training and a re-engineering of internal processes and controls, it can lead to dangerous misconfigurations and security vulnerabilities. It's a major cultural hurdle.
That's a huge shift in mindset. It means everyone, not just the IT department, has a role in cybersecurity in the cloud. Now, speaking of groundbreaking technology, let's talk about AI. You said it's critical, arguably the most disruptive technological force in banking for a generation.
Easily.
What's the next big jump we're seeing in AI that could truly revolutionize banking? And what makes it so different?
Well, artificial intelligence has evolved at just a blistering pace. We've moved rapidly from traditional predictive analytics, looking at past data to predict future outcomes,
You're right.
to the tangible applications of generative AI or Gen AI, which everyone's talking about now.
Creating text, images.
Exactly. And now we're moving towards the truly transformative potential of its successor, which is being called agentic AI.
Agentic AI. Grab.
For regional banks, navigating this revolution requires a clear understanding of the distinct capabilities, risks, and strategic implications of each stage.
So let's break that down. What are the practical uses of Gen AI right now?
Gen AI, powered by large language models, LLMs, offers a host of practical applications that can drive immediate efficiency gains and enhance both employee and customer experiences.
Like what?
We're seeing key use cases like internal co-pilots. These are AI assistants that empower employees by summarizing lengthy documents, drafting emails and reports, providing rapid access to internal knowledge bases. It's about augmenting human capabilities.
Making employees faster, smarter.
Exactly. Gen AI can also be used for process automation, automating the creation of regulatory reports, developing highly personalized marketing content for different customer segments, even assisting technology teams by generating code or converting legacy code to modern languages.
That's useful.
And a very compelling application is its use in enhanced risk management. A novel use involves employing Gen AI to create high-quality synthetic credit data, fake but realistic data.
Why would you do that?
It allows banks to rigorously test and validate their risk models and fraud detection algorithms without exposing sensitive, real customer information. You can stress test models safely.
That's fascinating. So it can really streamline a lot of the tedious, repetitive tasks that bankers face daily. But you mentioned a next big jump. What is agentic AI? How is it different?
That's where it gets really interesting and potentially game-changing. Agentic AI represents a paradigm shift. It moves from being a reactive tool that responds to human prompts,
like ChatGPT does now.
right, to being a proactive autonomous system. It can understand a goal, create a plan to achieve that goal, and then execute a series of complex, multi-step tasks with minimal human oversight.
So it doesn't just write or summarize, it does things.
This is not just an AI that can write, it is an AI that can act. Imagine an AI that doesn't just summarize a market report, but then takes action based on its findings, like rebalancing a portfolio.
Wow, what kind of actions?
The potential applications are truly transformative. In financial operations, AI agents could autonomously monitor market data and rebalance investment portfolios based on preset rules or even learned strategies. They could conduct continuous, real-time credit risk assessments of borrowers, flagging issues instantly. They could orchestrate complex accounting workflows like a month-end close or intercompany reconciliations.
The efficiency gains must be huge.
The efficiency gains can be staggering. A financial technology firm, HighRadius, reports that agentic systems can reduce the need for manual journal entries by as much as 86%.
86% reduction.
And achieve approximately 99% accuracy in automated transaction matching.
That's a level of efficiency that's almost hard to fathom. But if an AI is acting autonomously, making decisions, executing tasks, it feels like the potential for things to go wrong could be huge. What are the unique governance challenges there?
You've hit on the profound governance challenges. The very autonomy that makes agentic AI so powerful also makes it profoundly challenging from a governance perspective. The risks are an order of magnitude greater than with simple Gen AI.
What are the main concerns?
Key concerns include goal misalignment. An agent tasked with optimizing a portfolio for returns might gradually take on excessive risk that contradicts the customer's stated tolerance if not carefully constrained.
Right.
There's also the risk of cascading failures. An error made by one autonomous agent in a complex workflow could trigger a series of subsequent errors in other connected systems, potentially leading to a large-scale operational failure.
A domino effect.
Exactly. And finally, there's the loss of control and auditability. As these agents learn and adapt, their decision-making processes can become opaque, a black box,
Hard to know why it did what it did.
making it difficult to audit their actions and hold them accountable. This is a major concern for regulators who demand fairness and explainability in financial systems.
Absolutely.
This raises an important new class of internal risk that we're starting to call internal third-party risk.
Internal third-party risk.
Yeah.
How can something internal be third-party?
It sounds contradictory, right? But think about it. Banks have spent years developing robust third-party risk management, or TPRM, programs to oversee their human-run vendors.
Right.
An autonomous AI agent, while operating within the bank's own infrastructure, exhibits many of the same risk characteristics as an external vendor.
How so?
It operates with a degree of independence. Its performance can drift over time as it learns or encounters new data. It can be vulnerable to unique forms of manipulation or attack. And, as we said, its internal logic can be a black box.
So you need to manage it like a vendor, even though it's your own system.
Current risk management frameworks are simply not designed to govern these autonomous internal systems. It necessitates the development of a new agent risk management function that adapts the principles of TPRM to this new class of non-human actor.
So it's like a vendor inside your own walls that you still need to rigorously vet, monitor, and control. How can banks approach this AI revolution pragmatically, given all these complexities and risks?
To navigate this complex terrain, a pragmatic and phased approach to AI adoption is absolutely essential. McKinsey proposes a structured roadmap for banks to build capabilities and manage risk effectively.
What are the steps?
It begins with aligning with stakeholders. You need executive buy-in and dedicated investment for a clear, business-led AI strategy, not just IT playing with tools.
Okay, top-down support.
Then, they must standardize data. We'll talk more about data, but you have to recognize that AI is only as good as the data it's trained on. This means unifying and governing critical data resources first.
Garbage in, garbage out, amplified.
Exactly. Next, banks should install a modular architecture. Designing technology solutions with interchangeable API-driven components allows them to pursue multiple AI use cases in parallel without creating new monoliths.
Flexibility.
After that, they can pick the low-hanging fruit. Start with lower-risk, internal-facing use cases like an employee co-pilot to build skills, demonstrate value, and learn how to govern these systems.
Build confidence and experience.
Precisely. And only once a solid foundation of data, technology, and governance is in place should they roll out the more complex agentic AI to achieve true end-to-end transformation of core domains like underwriting or treasury management.
That's a really clear step-by-step approach to what sounds like a massive undertaking.
Yeah.
And all of this, the modernization, the AI, it really hinges on one crucial thing, doesn't it? Data.
It absolutely does. The success of every single digital initiative, from creating a seamless mobile banking app to deploying sophisticated AI agents, is wholly dependent on the quality, accessibility, and integrity of an institution's data.
But you said earlier data can be a mess at these banks.
For many regional banks, data remains a chaotic and underleveraged asset rather than a strategic one. Overcoming this fundamental data chaos is the foundational challenge of digital transformation.
What does that chaos look like?
The most common and debilitating issues include data gaps and silos. Critical customer and operational data is often incomplete, inaccurate, or trapped within disparate departmental systems. Different parts of the bank don't see the same picture.
And mergers make it worse.
This problem is frequently exacerbated by mergers and acquisitions, which introduce new, incompatible systems into the technology ecosystem, further fragmenting the data landscape.
So it's not just that they don't have enough data, but the data they have is often messy, unreliable, and scattered everywhere.
Precisely. You also have unreliable and outdated data. A heavy reliance on manual data entry processes and a patchwork of non-integrated systems inevitably leads to inconsistent, untrustworthy, and out-of-date information.
And making decisions on bad data.
Making critical business decisions based on this poor quality data is a recipe for strategic failure and increased risk. And finally, there's just data overload.
Too much data.
The sheer volume, velocity, and variety of data now available, from structured transactional data to unstructured text from customer feedback, social media can overwhelm the bank's existing tools and analytical processes. It makes it difficult to separate valuable signals from the noise.
This all sounds like a serious challenge. How does AI make these data problems even worse? Or does it?
The rush to adopt AI serves as a powerful magnifying glass for these underlying data problems.
Amplifies the flaws.
An AI model trained on fragmented, inaccurate, or biased data will only amplify those flaws, producing flawed insights and recommendations at an unprecedented scale and speed.
Give me an example.
Imagine a customer service chatbot trained on an outdated and inconsistent internal knowledge base. It might confidently hallucinate, make things up, and provide customers with incorrect information.
That leads to bad outcomes, angry customers.
Poor outcomes, compliance breaches, and a severe erosion of trust. This demonstrates that robust data governance is not merely a precursor to AI implementation. It is an absolute and non-negotiable prerequisite. You have to fix the data first.
So implementing a strong data governance program is step one before serious AI.
It's therefore a critical business function, not just an IT project. It establishes the framework necessary to manage data as a strategic enterprise asset, ensuring it is accurate, secure, consistent, and compliant with all regulations.
What does that involve practically?
It involves establishing a formal framework, defining and documenting clear policies, standards, and procedures for how data is collected, stored, accessed, and used throughout the organization.
Clear rules of the road for data.
Yes. It means defining roles and responsibilities, assigning clear ownership roles like data owners, data stewards, data custodians. Someone is accountable for each piece of critical data.
Okay.
It also requires actively managing data quality through processes for data cleansing, validation, and continuous monitoring. You can't just clean it once.
Needs ongoing effort.
And given the scale of modern data ecosystems, banks must leverage modern governance technology. Investing in AI-powered tools like data catalogs and data lineage platforms that can automate data discovery, classify sensitive information, and track the flow of data across systems is essential.
So it's about building a solid, clean data foundation, almost like the plumbing, before you try to build the smart house of AI on top of it.
That's a great analogy.
What's the payoff for getting this right? What can they do with good, governed data?
With a solid foundation of governed data, regional banks can finally unlock its immense value through advanced analytics, creating a significant competitive edge. The applications are vast.
Like personalization.
They can achieve hyper-personalization, moving beyond broad customer segmentation to deliver truly personalized experiences. By creating a 360-degree view of the customer, analyzing their transaction history, spending patterns, life events,
They can offer tailored advice.
banks can proactively offer tailored products, relevant financial advice, and customized services that anticipate customer needs. Much more relevant interactions.
What else? Better risk management.
They can also achieve enhanced risk management, leveraging predictive models to dramatically improve the accuracy and speed of critical risk functions. This includes more sophisticated credit scoring, real-time fraud detection that can identify anomalous patterns instantly, and more dynamic stress testing and scenario analysis.
And internally, can it make the bank run better?
Yes, importantly, it drives operational efficiency. By applying analytics to internal operational data, they can identify process bottlenecks, optimize resource allocation, and automate inefficient workflows.
You have an example.
A great example of this in practice is Regions Bank's Our Voice tool. It uses AI and natural language processing to aggregate and analyze customer feedback from multiple channels, surveys, call center logs, online reviews.
What does it do with that feedback?
It extracts actionable insights that directly inform product development, service improvements, and overall business strategy. It turns customer voice into tangible improvements.
It's clear from all this that the competitive environment for regional banks is no longer just about who has the most branches on Main Street.
Not all.
It's transformed into a complex multi-front war.
That's precisely it. Regional banks find themselves simultaneously defending against and competing with three primary types of adversaries, each posing a unique threat.
Okay, who's first?
First, the large national banks, the giants. These behemoths are leveraging their immense scale and resources to make massive investments in technology.
Billions on tech.
Right. They are deploying superior digital platforms that are proving highly effective at attracting younger customer demographics, like millennials and Gen Z, who really prioritize digital convenience.
And their size helps absorb costs.
Their vast balance sheets also allow them to absorb rising operational and compliance costs more effectively and to offer more aggressive pricing on deposits and loans, putting constant pressure on the margins of their smaller regional competitors.
So it's a battle of scale and tech muscle against the big guys. Who else is in this fight?
Next, we have the fintechs and non-bank institutions. This rapidly growing segment represents a fundamental disruption to the traditional banking model.
How are they different?
They're unburdened by the technical debt of legacy systems and often a less heavy regulatory framework. Fintech companies can develop and deploy niche financial products that are often cheaper, faster, and more user-friendly than those offered by incumbent banks.
Picking off profitable pieces.
They are systematically eroding the bank's historical information monopoly and are competing directly for the most profitable segments of the value chain. Think payments, consumer lending, wealth management.
And some are becoming banks themselves, right?
What's crucial here is that the threat is evolving. Some of the most successful fintechs, like Square, now Block, are obtaining their own FDIC-insured banking charters. That transforms them from disruptive partners or vendors into direct regulated competitors.
A whole new ballgame. Okay, who's the third threat?
And finally, a formidable long-term threat comes from big tech and the emerging crypto sector.
Apple, Google.
Exactly. Big tech firms possess vast customer networks, enormous data sets, and unparalleled technological prowess. A significant emerging concern is the potential for these platforms to create what's being called a choke point 3.0.
Choke point 3.0, what's that?
The idea is they could leverage their control over think user data, transaction data, and payment ecosystems to charge exorbitant fees for access, effectively becoming gatekeepers and potentially strangling competition from both banks and smaller fintechs.
Controlling the pipes.
Controlling the pipes and charging a toll. And then the rise of digital assets and cryptocurrencies also presents a new, albeit volatile, competitive vector that traditional banks are still struggling to address effectively.
That's a crowded and dangerous battlefield.
Yeah.
So what are the regional banks doing to fight back? We've seen a definite resurgence of M&A, mergers and acquisitions, as a primary strategic lever for them. Why is consolidation so appealing right now?
M&A has indeed reemerged as a critical strategic lever. The strategic rationale for these deals is compelling and multifaceted.
What's the main driver? Scale.
The most immediate driver is the pursuit of economies of scale. Merging allows for the consolidation of duplicative back-office functions, the optimization of overlapping branch networks, and the ability to spread those rising fixed costs, especially compliance and technology, over a much larger asset base. It's about achieving efficiency through size.
So bigger means better equipped to handle the overhead. What else? Buying tech.
Exactly. Another key driver is acquiring technological capabilities and talent. For many regional banks trapped by legacy systems, M&A is often the fastest and frankly most viable path to acquiring modern digital platforms and specialized expertise in critical areas like AI, data analytics, cybersecurity.
Cheaper to buy than build sometimes.
Building these advanced capabilities organically is frequently too slow, too expensive, and too difficult from a talent acquisition perspective. So M&A is a high-stakes gamble to try and pay down years of accumulated technical debt in a single transaction.
And expanding their footprint.
Furthermore, consolidation allows banks to expand their geographic reach and, perhaps more importantly, to achieve a position of local market leadership. Research indicates that having a high relative market share in specific local deposit and lending markets is a more powerful driver of profitability than simply having a sprawling, subscale national presence. Being big in your town matters.
That all sounds like a very logical strategy on paper. But we know M&A is notoriously difficult, especially in banking. What are the perils? Where do most deals tend to fall apart?
Bank M&A is indeed notoriously difficult to execute successfully. Historical data consistently shows that a majority of banking deals fail to deliver their promised value. Many actively destroy shareholder wealth.
Wow, where's the biggest stumbling block?
The single greatest point of failure time and time again is technology integration.
Making the systems talk to each other.
The task of merging two disparate core banking systems, digital platforms, and complex data infrastructures is immensely risky and complex. Underestimating this challenge pre-deal is a common mistake.
And the consequences.
It leads to massive budget overruns, prolonged operational disruptions, poor customer experiences, and significant customer churn. People leave if it's a mess.
What's a key mistake there?
One of the most dangerous pitfalls is the failure to commit to a single target platform early on. Allowing the merged entity to continue operating on two separate systems for an extended period, sometimes years, creates crippling long-term inefficiencies and prevents the realization of those cost synergies that justify the deal in the first place.
Kicking the can down the road on the hard tech decisions.
Exactly. It seems easier initially, but it's disastrous long-term.
So it's not just about buying another bank. It's about making their IT systems truly work together as one, and that's often where it falls apart. What are some of the critical elements in that tech integration to get it right? You mentioned phases.
Yes, thinking about it in phases helps. In the pre-deal due diligence phase, the absolute make or break is a deep, deep dive into the target's tech and data.
Look under the hood properly.
You need to understand what you're really buying, beyond just the balance sheet. Are there hidden liabilities like severely outdated systems or significant cyber vulnerabilities? You need to know before you sign.
Okay, phase one, know what you're buying. Phase two.
Phase two is integration planning, pre-close, once you decide to proceed, but before the deal closes. Here, the most crucial element is defining the target state architecture.
Deciding which systems win.
Deciding which systems will be the go-forward ones for the combined entity, and meticulously planning how data and operations will migrate. This means explicitly avoiding that pitfall of long-term parallel system operations. You need a clear blueprint.
Got it. And after the deal closes, phase three.
Finally, post-close execution and monitoring. Here, the key is a disciplined approach to the cut over the actual migration. This often involves mock conversions in a test environment first, like dress rehearsals.
Practice makes perfect.
And an intense focus on seamless customer and employee transitions during the real conversion. Because a disrupted customer experience can lead to significant churn, undermining the deal's value. Real-time monitoring of performance after cutover is also critical.
That's a highly detailed and practical checklist. Seems essential for success. Beyond M&A, what other strategies are regional banks employing to thrive in this tough environment, especially given the pressures on net interest income we talked about? They need other revenue sources, right?
Yes, this raises that important question. How do they grow beyond their traditional lending base? The strategic imperative to grow non-interest income has become more critical than ever.
Fee income, basically.
Right. Regional banks are actively pursuing revenue diversification strategies to create more resilient and profitable business models. This involves a deliberate shift to expand fee-generating activities that are less sensitive to interest rate fluctuations.
What kind of activity?
Common sources of diversified revenue include wealth management and advisory services, insurance brokerage, treasury and cash management services for commercial clients, certain capital markets activities, and a wide range of payment services.
So it's about extending their service offerings and earning more from those services. Is this always a straightforward win, or does it come with its own set of risks? Diversification sounds good, but is it always?
Not at all. The path to successful diversification is not without risk. It can be a double-edged sword, as they say.
How so?
While the potential benefits are clear, smoother earnings, potentially reduced volatility, enhanced profitability, the outcome is highly dependent on the nature of the diversified activities and, crucially, the bank's ability to manage the associated risks effectively.
So what does the research show?
Some academic studies have found a clear positive impact, showing that revenue diversification increases risk-adjusted profits and enhances bank stability. Makes sense. Conversely, other research warns that if the new, non-traditional activities are inherently riskier than core lending, they can actually increase earnings volatility and potentially reduce overall profitability.
Can you give an example?
For instance, one detailed study of South Asian commercial banks found that while overall diversification into non-interest income was beneficial, a deeper analysis revealed that income specifically from fees and commissions actually had a negative impact on profitability and stability in that context.
Interesting. So the type of non-interest income matters.
It highlights the need for a nuanced and carefully risk-managed approach to diversification, rather than a blind pursuit of any and all non-interest income opportunities. You have to understand the risks you're adding.
That's a critical distinction. It's not just about what you diversify into, but how you manage the risks of those new ventures. And speaking of new ventures, many regional banks are exploring fintech partnerships as an alternative or maybe a complement to M&A.
Right.
It's almost an if you can't beat them, join them approach.
Indeed, and it makes sense. This approach allows banks to rapidly fill gaps in their technological capabilities, accelerate the launch of new products, and deliver innovative services to their customers without the immense cost, time, and complexity of building everything in-house.
Faster time to market.
Much faster. A variety of partnership models have emerged, each with different levels of integration and strategic commitment.
What are some examples?
One common model is banking as a service, or BOSS.
BOSS. Heard that term.
In this model, the bank essentially acts as the regulated infrastructure provider. It offers its core banking functions like deposit taking and payment processing to a fintech partner through APIs. The fintech then builds its own customer-facing product on top of the bank's charter and rails.
So the bank provides the plumbing, the fintech builds the house.
That's a good way to think of it. Another model is where the fintech acts more like a traditional vendor or technical partner. The bank licenses a fintech's technology solution, like a slick digital loan origination platform or a new mobile banking app, and offers it to its own customers under the bank's brand. It's a white label arrangement.
Okay. Any other models?
Simple referral partnerships exist too, where the bank and a fintech partner simply refer customers to each other for specific products or services.
Like cross-selling.
Exactly.
Wow.
And then there's what's sometimes called the bank model partnership. This involves deeper integration where the bank serves as the official lender or account issuer, but the entire customer experience and maybe even the back-end processing is tightly integrated with the fintech's front-end platform and systems. It's a very close collaboration.
These partnerships sound like a smart way to get innovative quickly without having to build everything from scratch. But what are the catches? Are there unique risks that arise when traditional banks team up with these agile, maybe less regulated tech companies?
While these partnerships offer a faster path to innovation, they absolutely introduce their own set of complex risks. A successful partnership requires a robust and sophisticated governance framework that goes far beyond a standard vendor agreement you might have with, say, your office supply company.
Needs much more oversight.
Key success factors include establishing a joint governing body with executive representation from both the bank and the fintech. This facilitates rapid decision-making.
Okay.
You need clear and aligned compliance and risk management oversight, who's responsible for what. And you need a completely re-engineered change management process internally at the bank to accommodate the fintech's much faster pace of development and deployment. They move faster.
Banks need to keep up.
Crucially, the bank's existing third-party risk management, or TPRM, program must be significantly enhanced to manage the unique and heightened risks associated with these deep technological and operational integrations. It's not just vendor management, it's partnership management.
And you mentioned the systemic risk earlier, nth-party risk.
Yes, what's subtle but potentially very significant here is a systemic risk that arises from the proliferation of these partnerships across the industry. As dozens, maybe hundreds of regional banks partner with the same few dominant fintech service providers for critical functions, think core processing add-ons, payment platforms.
Concentration risk.
A new form of concentration risk emerges. This is what we call nth-party risk. It means that a significant operational or cybersecurity incident at a single popular fintech partner, or perhaps at its underlying cloud infrastructure provider, the nth party down the chain, would not just impact one bank.
It could hit many banks at once.
It could simultaneously disable a critical function for a large number of regional banks across the country, creating a potential systemic event that falls outside the direct control or even visibility of any individual institution.
That's worrying. Are regulators looking at this?
Regulators are definitely beginning to focus on this critical third-party risk, but many banks' TPRM programs are not yet mature enough to adequately assess and mitigate these complex, interconnected dependencies. It's a developing area of concern. So all these strategic maneuvers on the competitive battlefield we just discussed, the M&A, the partnerships, the diversification, they must be supported by a profound internal transformation.
You can't just change the strategy without changing how the bank works inside.
Exactly. To power digital innovation, achieve those necessary efficiencies we talked about, and deliver a superior customer experience, regional banks must fundamentally re-engineer their internal operations, overhaul their approach to human capital, their people, and cultivate a digital-first culture.
So operations, people, culture.
These internal changes are not secondary to the external strategy. They are the essential engine that makes the external strategy possible.
Okay, let's start with operations. You mentioned operational excellence being baseline now.
Yes, in an environment of compressed margins and rising costs, operational excellence is no longer a goal you strive for. It's a baseline requirement for survival.
And how do they achieve that? Cost cutting.
Well, the approach to cost management has matured beyond simple reactive cost cutting to a more holistic strategy of strategic cost optimization.
What's the difference?
It involves a continuous process of reviewing spending, driving efficiencies in core processes, and, critically, reallocating the resulting savings into strategic investments that create long-term value for the bank and its customers. It's not just cutting, it's cutting and reinvesting smartly.
What kind of savings targets are we talking?
Banks are setting ambitious targets, aiming for cost efficiencies of maybe 10% in the near term and as high as 20–30% over the next 3 years.
That's significant. Where do they find those savings?
This requires looking beyond traditional frontline functions and applying a rigorous cost and value lens to corporate departments like finance, risk, and compliance, as well as aggressively optimizing third-party vendor spend. Everything is under review.
So it's about being lean, but also being smart about where those savings go. What are the key tools for achieving this level of efficiency? Automation.
A primary lever for achieving this level of efficiency is process automation. Robotic process automation, or RPA, has become a key tool.
RPA bots.
Exactly. Automating high-volume, repetitive, and rule-based tasks prevalent in banking operations. Things like new customer onboarding, loan and mortgage processing steps, accounts payable, routine compliance checks.
And the payoff.
The benefits are clear and quantifiable. A well-implemented RPA program can reduce costs for those specific tasks by 25% to 50% and often achieve a positive return on investment in less than a year. Quick wins.
Okay, but RPA is just automating existing steps, right? What's next?
The new wave of automation, however, goes beyond simple RPA. It involves intelligent automation, where RPA is infused with AI capabilities like natural language processing, understanding text and documents.
Thunderbots.
And it's part of a broader hyper-automation strategy that seeks to automate entire end-to-end business processes, not just discrete tasks within a process, connecting the bots together, essentially.
And this is growing fast.
The growth in this area is explosive. The global banking process automation market is projected to expand from around $3 billion in 2022 to over $19 billion by 2032. Huge growth.
That's incredible growth. But if RPA is automating so much, isn't there a risk it just extends the life of those old legacy systems that banks are trying to get rid of? Does it become a Band-Aid rather than a real fix?
That's a critical point and a real danger. RPA should be viewed strategically as a bridge, not as a final destination.
A bridge to what?
While it is an incredibly powerful tool for extracting immediate efficiency gains from processes that are often built around clunky legacy systems, its greatest strategic value lies in its ability to free up capital and operational capacity.
Use the savings for real modernization.
Exactly. The cost savings generated by automating manual workarounds can and should be directly reinvested to fund the deeper, more fundamental project of modernizing the underlying legacy systems themselves.
And then get rid of the bots.
Once the new modern system is in place, the RPA bots that were serving as that temporary bridge can often be decommissioned. Approaching automation in this way, as a self-funding mechanism for true transformation, is a far more strategically sound approach than seeing it as a permanent fix. Using it as a permanent fix can inadvertently prolong the life of the very legacy systems the bank needs to replace.
Makes sense. Don't let the Band-Aid prevent the surgery. Okay, what about physical operations? Branches, are they just dying out?
And speaking of physical presence, the branch network is another critical area for optimization. But it's not as simple as just closing them all.
Why not? Everyone banks online now, right?
While digital channels have certainly become the preferred method for routine transactions like check deposits or transfers, a significant portion of customers. One study found 45% still value and prefer face-to-face interactions for more complex financial decisions and advice. Big moments.
Buying a house, retirement planning.
Exactly. Things where trust and conversation matter. The modern strategy, therefore, is not about branch elimination, but about branch modernization.
What does a modern branch look like?
It involves transforming the branch from a transactional center, lines for tellers, into a high-tech, high-touch advisory hub.
Tech and people working together.
The goal is to create a seamless omni-channel experience by integrating cutting-edge technology like AI-driven analytics to arm bankers with customer insights before a meeting, digital signage for dynamic communication, efficient appointment scheduling systems with the human expertise of financial advisors, making the human interaction more valuable.
That's a smart evolution, recognizing that the human element still matters for big decisions. But all this transformation, new tech, new branch models, new processes, requires people. And you mentioned regional banks are facing a human capital crisis on two distinct fronts.
They absolutely are. It's a major constraint. First, there's a fierce war for talent.
Competing for skilled workers.
Regional banks struggle to attract and retain top talent, especially for critical technology roles. Think software development, cloud engineering, data science, cybersecurity.
And they're competing against.
The competition isn't just with larger banks, but with the entire tech industry. Google, Amazon, startups which can often offer more compelling compensation packages, a different kind of culture, and maybe more exciting career opportunities.
So how can banks compete?
To compete effectively, regional banks must adapt to the expectations of the modern workforce. That means increasingly prioritizing a healthy work-life balance, offering hybrid and flexible work options where possible.
It's not just 9 to 5 in the office anymore.
No. And also appealing to a sense of purpose, demonstrating commitment to social and environmental goals like diversity, equity, and inclusion, DEI, and ESG, and offering clear, tangible opportunities for career development and growth within the bank.
So it's not just about the paycheck anymore, but the whole employee value proposition that needs to evolve. What's the second front of this crisis?
Precisely. Simultaneously, there is a critical and growing mismatch between the skills the bank needs for the future and the skills its current employees possess.
The internal skills gap.
Yes. This skills gap is most acute in advanced technical domains like AI, cloud, and data analytics, but it also extends to essential human skills.
It's like what?
Creative problem-solving, critical thinking, adaptability. Skills needed to thrive in a rapidly changing environment using the new tools effectively.
How big is this gap?
Research from the Financial Services Skills Commission in the UK, which likely mirrors the situation in the US, estimated that a staggering 16% of the financial services workforce requires significant upskilling just to remain proficient in their current or near-future roles.
1 in 6 workers needs major retraining.
It's significant. This human capital deficit has direct operational consequences. It leads to slower project execution, increased risk of failure for technology initiatives, and a greater dependency on expensive external vendors and consultants to fill the gaps.
And you mentioned something about mid-career staff.
Yes, what's truly a hidden dynamic exacerbating this skills gap is the hollowing out of mid-career staff.
Hollowing out, what does that mean?
Over the past couple of decades, waves of industry consolidation and cost-cutting initiatives have often led to the reduction of mid-level management and experienced professional roles, flattening the organization chart.
Okay.
This has created a kind of generational skills chasm within many banks. On one end, you have a cohort of senior, long-tenured employees with deep expertise in the fundamentals of banking and valuable experience.
And veterans.
On the other end, there's a new generation of younger hires with modern digital skills in areas like data science and software engineering.
The digital natives.
But the missing middle experienced bankers, who are also digitally savvy, who can act as crucial translators, mentors, and bridges between these two worlds, is often absent.
The people who can connect the old and new.
Exactly. This communications gap hampers innovation. Senior leaders may not fully grasp the potential of new technologies, and junior tech talent may not understand the critical nuances of banking risk and regulation. This disconnect is a significant root cause of the cultural inertia that so often stalls digital transformation efforts.
That's a powerful insight. It's not just a skills gap, but a generational bridge that's missing. So what's the strategic response to this multi-pronged human capital crisis? What can they do?
It requires a multi-pronged strategic response. There's no single silver bullet. The single most important strategy, arguably, is prioritizing internal development,
Training their own people.
investing heavily in upskilling and reskilling the existing workforce. Look, most of the people who will deliver the bank's future success are already employees today.
Right.
This requires a real commitment to continuous learning through online platforms, internal workshops, formal certification programs, and actively promoting internal mobility, creating clear career pathways for people to grow into new roles.
Okay, develop from within. What else?
Second, modernizing recruitment and talent acquisition. Banks must fundamentally change how they hire, shifting to a more modern, skills-based hiring approach rather than just looking at degrees or past titles, using digital tools and predictive analytics in hiring, and expanding the search for talent beyond traditional local geographic pools, especially with remote work possibilities.
Cast a wider net.
Exactly. And third, building a compelling employer brand. In a competitive talent market, compensation is just table stakes. It gets you in the game, but doesn't guarantee you win.
Need more than money.
To truly differentiate, regional banks must build and actively promote a compelling employer brand that showcases a positive and inclusive workplace culture, offers genuine flexibility, and demonstrates a clear commitment to employee growth and well-being. Why should someone choose to work here?
It sounds like a complete overhaul of how they view and manage their talent is needed. But you've mentioned before that technology investments and even talent strategies alone won't suffice. The biggest barrier is often cultural. What do you mean by that? Why is culture so important?
That's absolutely true and often underestimated. Digital transformation is a profound organizational change. It requires a fundamental shift in the mindset, the behaviors, and the day-to-day working habits of pretty much every employee, from the C-suite to the front line.
Change is hard.
Very. Organizational inertia, we've always done it this way. Resistance from middle management who may feel their roles or authority are threatened, and a general fear of disruption are powerful forces that can derail even the best-funded technology projects.
People resist change.
And the ultimate success or failure of a transformation initiative is most closely correlated with user adoption and change readiness. How willing and able are people to actually use the new tools and processes?
Makes sense.
A bank's existing culture can act like an organizational immune system. If not actively managed, it will identify new technologies and processes as foreign bodies and work to reject them.
Can you give an example of that?
Sure. Imagine leadership invests millions in a new, state-of-the-art digital collaboration platform designed to break down silos.
Sounds good.
However, if the bank's culture continues to reward old behaviors, if performance is still measured primarily by face-to-face meetings rather than digital engagement, if experimentation is discouraged and failure is punished, if information remains siloed within departments despite the new tool,
then people won't use it or won't use it properly.
employees will see no real incentive to change their ways. They will either refuse to use the new platform, find ways around it, or develop inefficient workarounds to continue operating in the old familiar ways. The technology investment will fail to deliver its expected ROI, not because the technology was flawed, but because the organizational culture rejected it.
That's a classic case of leading a horse to water, but not being able to make it drink. So how do you actively manage this cultural shift? Where does leadership come in? How do you change the culture?
Cultivating a digital-first culture is a critical leadership responsibility. It absolutely must start at the very top.
Tone from the top.
The executive team must not only fund the transformation, but must also actively champion it. Consistently communicating a clear and compelling vision for the future, explaining the why, and importantly, modeling the desired new behaviors themselves, they have to walk the talk.
What kind of cultural shifts are needed?
It involves fostering an inclusive digital culture that actively breaks down those departmental silos we talked about, promoting deep and continuous collaboration between business teams and technology teams. They need to work together seamlessly, and ensuring that all employees are equipped with the digital literacy and skills necessary to adapt and thrive in the new environment.
Invest in the people side of change.
A significant portion of any digital transformation budget must be dedicated to this human side of change. That includes comprehensive training, robust change management programs, clear communication, and maybe even a deliberate re-engineering of performance management and incentive systems to reward and reinforce the desired digital-first behaviors. Pay people for working in the new way.
So it's about changing hearts and minds and incentive structures, not just installing new software. Ultimately, all this internal re-engineering, the operations, the talent, the culture, It should lead to one thing, right? A superior customer experience for a digital-first world.
Precisely. That's the ultimate goal. The ultimate goal of all this internal reengineering is to deliver a superior experience to the customer.
The customer expectations have changed.
In the digital age, customer expectations have been irrevocably shaped by their interactions with leading technology companies. Amazon, Netflix, Apple. They now expect and demand financial services that are seamless, intuitive, highly personalized, and available 24/7 on the channel of their choice.
And if they don't get it,
The quality of the digital experience has become a primary driver of both customer retention and new customer acquisition. If it's clunky, they'll leave.
so the aim is a true omni-channel experience.
Yes, the strategic goal is to create a true omnichannel experience. This means ensuring that the customer journey is consistent, connected, and frictionless. Whether they are interacting with the bank through its mobile app, a website chatbot, a call center agent, or a banker in a physical branch.
Same experience everywhere.
Achieving this requires the deep integration of data and processes across all of these touch points so that the bank has that single, unified view of the customer relationship and can provide context-aware service at every interaction. The branch banker knows what happened on the app yesterday.
And data plays a key role here too.
Leveraging data and analytics is the key to creating a differentiated customer experience. By analyzing the vast amounts of data available, banks can gain deep insights into customer journeys, identify pain points, anticipate future needs, personalize product recommendations and financial advice, and proactively resolve potential issues before they even become customer complaints.
And trust is crucial.
And finally, building and maintaining customer trust in this data-driven world is absolutely paramount. This requires not only delivering exceptional service, but also demonstrating an unwavering commitment to robust cybersecurity and transparent ethical data privacy policies. Customers need to feel safe.
Wow. We've covered a lot of ground today, from the economic headwinds and regulatory shift to the complexities of AI, the need for new talent, cultural change, and the fierce competitive landscape. But it's crucial, as you said earlier, to understand that these challenges are not isolated. They form a complex, interconnected system. What stands out to you as the core takeaway here, the big picture?
What truly stands out is how these challenges create a kind of dynamic flywheel, or maybe a vicious cycle for some.
Explain that flywheel.
Okay. At the center lies the burden of legacy systems. That limits agility and innovation, right? This technological deficit makes it nearly impossible to attract top-tier technology talent, leading to a widening talent gap.
Can't get the people you need.
Unable to build the necessary capabilities internally, banks are often driven toward mergers and acquisitions as the primary means of acquiring modern platforms and skilled personnel.
Buy the tech and talent.
But, as we discussed, these deals introduce immense integration risk, particularly around technology and culture, which can lead to operational failures and service disruptions.
M&A is hard.
Such failures, in turn, attract heightened regulatory scrutiny, often resulting in supervisory actions that demand significant resource allocation for remediation. Fix the problems from the failed integration.
Back to fighting fires.
This diversion of capital and leadership focus then starves the very modernization initiatives needed to address the root cause, the original legacy systems.
And the wheel turns again.
This self-reinforcing cycle can trap an institution in a state of strategic paralysis, making it increasingly vulnerable to more agile and technologically advanced competitors. Breaking this cycle requires a coordinated strategy that addresses all points on the flywheel simultaneously, not sequentially.
That's a powerful way to visualize the problem. It really highlights that trying to solve one piece in isolation just won't work. For executive leadership listening, trying to cut through this complexity and establish clear priorities, what's an actionable framework they can use? How do they break the cycle?
For clarity and prioritization, we propose thinking about it using a modernize, monetize, manage model. It provides a logical sequence for action, while recognizing the interconnectedness we just discussed.
Okay, modernize, monetize, manage. Break that down. First, modernize.
First, modernize the core. This is the non-negotiable foundation. The first priority and the first dollar of discretionary investment must be directed toward building a modern, modular, cloud-based technology and data infrastructure.
Get the foundation right.
This includes a systematic plan to decommission legacy systems, the implementation of that robust data governance framework we talked about, and the adoption of cloud computing as the standard for all new development. This is not just an IT project. It is a fundamental replatforming of the entire business. It's the essential prerequisite for everything else.
Okay, foundation first. Then monetize.
Second, monetize the relationship.
Mm.
With a modern core in place, the focus shifts to leveraging this new capability to drive revenue and enhance customer value. This is the offensive phase of the strategy.
How do they do that?
It involves using the newly accessible and governed data to power advanced analytics for that hyper-personalization of products and services we discussed. It means strategically diversifying into high-growth, non-interest income streams like wealth management or treasury services, but doing it smartly based on the risk discussion.
And partnerships fit here.
And it entails forging smart, API-driven partnerships with fintechs to rapidly expand the customer value proposition and fill capability gaps. The modern core enables the bank to monetize its deep customer relationships in ways that were previously impossible.
Okay. Modernize, monetize, and manage.
And third, manage the risks. This principle isn't a final step. It must be embedded throughout the entire transformation from day one.
Risk management across the board.
It requires building a forward-looking and proactive risk management and governance culture that is commensurate with the new technological landscape. This includes discipline, data-driven management of traditional risks like CRE, concentration, and liquidity. But critically, it also means developing new capabilities to govern the unique risks of emerging technologies.
Like the AI risks.
Such as establishing a robust agent risk management framework to oversee autonomous AI systems. And finally, it demands that the human capital and cultural transformation of the organization keeps pace with the technological change, ensuring that the bank's people have the skills, the mindset, and the right incentives to operate effectively and safely in the new environment.
That's a comprehensive framework. Modernize the tech. Monetize the customer relationship using that tech, and manage the new and old risks throughout. It really reiterates that transformation doesn't mean regional banks have to abandon their identity, does it? The community focus, the personal touch.
No, absolutely not. That would be a mistake. The ultimate goal of this transformation is not for regional banks to become faceless technology companies. It's to leverage technology to amplify the unique and enduring strengths that have always been their hallmark.
Which are?
Deep community ties, intimate local market knowledge, and a level of agility and personal service that larger national or global competitors simply cannot replicate.
So the future is hybrid.
The successful regional bank of the future will be a true hybrid institution. It will seamlessly blend the high-tech convenience and personalization of a leading digital player with the high-touch, trusted advisory relationship of a community pillar.
Best of both worlds.
It will compete on the speed and innovation enabled by its modern technology stack, but it will win on the trust and deep relationships cultivated by its people.
It sounds like a difficult balance.
This is the strategic tightrope that leadership must walk. The journey is challenging, no doubt. It requires a delicate balance between investing in innovation and maintaining rigorous control, between embracing automation and empowering human talent, and between driving efficiency and deepening customer engagement.
So what's the key to success?
Success will hinge on leadership's ability to build a resilient and agile organization that can adapt to a future of continuous change, and fundamentally, to remember that the most powerful technology is that which enhances, rather than replaces, the fundamental human connection at the heart of banking.
And what a journey it is for regional banks.
Yeah.
This has been incredibly insightful. For you listening, you now have, hopefully, a comprehensive understanding of the complex landscape they're navigating.
Mm-hmm.
And as we often find, this isn't just about financial institutions. It's truly a blueprint for adapting to rapid change in almost any sector facing similar disruptive forces.
And maybe a final thought to leave you with, something broader to consider. As we navigate a world increasingly driven by digital transformation in all aspects of our lives,
Yes.
how do we ensure that the convenience and efficiency technology offers don't inadvertently erode the very trust and personal connection that remain vital in all our relationships, financial or otherwise? Something to ponder.
That's a powerful thought to leave you with indeed. Keep exploring, keep questioning, and keep deep diving into the topics that pique your curiosity. We'll be back next time with another deep dive.
Thanks for having me.